Welcome back, my friend, because we need to slow this conversation down and really talk about something that is quietly setting people up for a painful surprise. And I'm seeing it happen every single week. Everywhere I look, I hear people saying the same thing over and over again, that the president promised no taxes on Social Security so they can finally stop worrying about it. I wish that were true, I really do, because nobody enjoys writing checks to the IRS, and if there were a way to unsubscribe from taxes entirely, I would have done it years ago. But the reality is very different, and believing this myth is one of the fastest ways to end up blindsided by a tax bill you never saw coming. Here's the uncomfortable truth right up front. If you receive Social Security benefits and you have any other income at all, whether that's part-time work, a pension, IRA withdrawals, interest, dividends, or even certain types of tax-free interest, there is a very real chance that some of your Social Security benefits are still being taxed. This hasn't magically disappeared. The rules haven't changed. And yet millions of people are planning their retirement based on the assumption that taxes on Social Security are gone. They are not. I want you to understand something very clearly. Promises and proposals are not law. Headlines are not policy. Sound bites are not changes to the tax code. Until Congress passes legislation and it is signed into law, the system works exactly the same way it has for decades. And that system is complicated, outdated, and in many ways deeply unfair. But it is still very much in force today. I've spent years helping families navigate Social Security and government benefits. And I can tell you without hesitation that taxes on Social Security are one of the most misunderstood issues out there. I've watched people retire with confidence, believing they had everything figured out, only to receive a tax bill months later that wiped out their savings cushion. I've seen widows panic because they didn't realize taking a small job would suddenly trigger taxes on their benefits. I've helped people uncover the fact that they were paying far more than they needed to simply because nobody ever explained the rules to them. That's why we're having this conversation today. Not to scare you, but to arm you with information. Because when you understand how this works, you can plan. And when you plan, you protect yourself. To understand where we are today, we have to go back to where this all started, and that means going back to the 1980s. At that time, Social Security was facing long-term financial concerns, and Congress formed what was known as the Greenspan Commission. Their job was to figure out how to stabilize the system and make sure it could continue paying benefits into the future. The commission proposed several major changes. They raised the full retirement age. They adjusted benefit calculations. And for the first time in history, they decided to tax Social Security benefits for certain retirees. This change officially took effect in 1984. Now let me be very clear here. Social Security was originally designed as a social insurance program funded by payroll taxes that workers paid throughout their careers. Every paycheck, you paid 6.2% of your wages into Social Security, and your employer paid another 6.2% on your behalf. Over a lifetime of work, that adds up to a significant amount of money. So when the government decided to tax Social Security benefits, many people, myself included, felt it was a form of double taxation. You paid taxes on your income while you worked, you paid payroll taxes specifically earmarked for Social Security, and now you're being taxed again when you receive the benefits. Whether you agree with it or not, that's the system we have. At the time, Congress tried to justify this decision by saying the tax would only apply to wealthy retirees. They set income thresholds to determine who would be affected. If you were a single filer with income above $25,000, or a married couple filing jointly with income above $32,000, a portion of your Social Security benefits could be taxed. Back in 1984, those thresholds made some sense. In retirement, earning more than $25,000 or $32,000 was relatively uncommon. This tax was truly aimed at higher income households. Here's where the story takes a turn from reasonable to infuriating. Those thresholds were never indexed for inflation, not once, not in the 1990s, not in the 2000s, not after the Great Recession, not after massive increases in housing costs, healthcare costs, and everyday expenses. We are now more than 40 years removed from when those numbers were set, and they are exactly the same today. Think about that for a moment. Everything else in your life has gone up in price. Rent, groceries, gas, electricity, insurance, prescription drugs, even wages slowly but surely have risen over time. But the income thresholds that determine whether your Social Security benefits are taxed are frozen in time, stuck in the Reagan administration. What that means in practical terms is devastating. A tax that was originally intended to affect only wealthy retirees now hits ordinary, middle-class seniors who are simply trying to survive. People who never thought of themselves as high earners are suddenly treated as if they are. And while this has been happening quietly year after year, Congress has done essentially nothing to address it. There has been no major reform to Social Security taxation in 4 decades. Instead, lawmakers argue, delay, and kick the problem down the road, all while more and more retirees get pulled into the tax net. At the same time, the Social Security Trust Fund is facing a very real deadline. According to current projections, in just over 7 years, the trust fund will be depleted. That doesn't mean Social Security disappears, but it does mean benefits will be automatically cut by around 23% across the board unless Congress acts. This is not speculation. This is written plainly in the trustees' reports. It doesn't matter whether you're already retired, about to retire, or decades away. If nothing changes, that cut affects everyone. You may have heard politicians claim that Social Security is running out of money because funds were stolen. That narrative is popular because it's emotionally powerful, but it's also misleading. The government did borrow money from the trust fund over the years, but those funds are accounted for and interest is paid on them. In fact, roughly 10% of current Social Security benefits are funded by interest from the trust fund's holdings. The real problem is not theft. The real problem is inaction. Lawmakers have known about these issues for decades and have repeatedly failed to implement meaningful long-term solutions. Now here's where things get a bit more nuanced, and this is important to understand. Not everyone pays taxes on Social Security benefits. In fact, somewhere between 40 and 50% of beneficiaries pay no federal tax on their benefits at all. If Social Security is your only source of income, there's a good chance you fall into this category. The key factor is something called combined income, and this is where confusion sets in for most people. Combined income is not just your Social Security benefits. It's a specific calculation that includes 3 components. First, your adjusted gross income, which includes wages, pensions, IRA, and 401k, withdrawals, interest, dividends, and other taxable income. Second, any tax-exempt interest you earn, such as interest from certain municipal bonds. And third, half of your Social Security benefits. That last part surprises a lot of people. The IRS does not count all of your Social Security benefits when determining whether they are taxable. They only count half. So let's break this down with real numbers. Suppose you receive $30,000 per year in Social Security benefits. For the purpose of calculating combined income, only $15,000 of that amount is included. If you are single and your combined income is below $25,000, none of your Social Security benefits are taxed. If your combined income falls between $25,000 and $34,000, up to 50% of your benefits may be taxable. And if your combined income exceeds $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, the thresholds are slightly higher. Combined income below $32,000 means no taxes on benefits. Between $32,000 and $44,000 means up to 50% may be taxable. Above $44,000 means up to 85% may be taxable. Notice something important here. These percentages do not mean you pay 85% in taxes. They mean that up to 85% of your benefits are included as taxable income, which is then taxed at your regular income tax rate. Let's walk through a simple example. Imagine you are single and receive $24,000 per year in Social Security benefits. You also work part-time and earn $10,000. Half of your Social Security benefits is $12,000. Add that to your $10,000 in earnings, and your combined income is $22,000. That's below the $25,000 threshold, so none of your Social Security benefits are taxed. Now imagine you get a raise or work a few extra hours and earn $16,000 instead. Half of your Social Security benefits is still $12,000, but now your combined income jumps to $28,000. Suddenly, up to 50% of your Social Security benefits are taxable. A small increase in income just triggered a completely different tax outcome. This is what makes the system so punishing. People are not getting taxed because they are wealthy. They are getting taxed because they are trying to make ends meet. Working retirees are a perfect example. Many people simply cannot live on Social Security alone, so they take part-time jobs. They want to stay active, supplement their income, and maintain some independence. But that extra income often pushes them over the threshold, causing their benefits to be taxed. Widows and widowers face an even harsher reality. When a spouse dies, one Social Security check disappears, but most household expenses remain the same. Many widows return to work or increase their hours just to survive, only to discover that this triggers taxes on their benefits. Then there are people who did everything right. They saved responsibly in 401ks and IRAs throughout their careers. But when they start taking withdrawals in retirement, that income counts toward combined income and can push them into higher taxation of their Social Security benefits. In effect, they are penalized for planning ahead. Disabled workers are not exempt either. If you are receiving Social Security disability insurance and work within allowed limits, that income can still cause your benefits to be taxed. Veterans can also be affected, particularly if they supplement their Social Security with part-time work or other taxable income. The common thread here is that the people being hit the hardest are often the ones trying the hardest to stay afloat. Here's another piece of the puzzle that most people don't realize. Taxes on Social Security benefits actually help fund Social Security itself. When you pay federal taxes on your benefits, that money is sent back into the Social Security Trust Fund. In a recent year, approximately $54 billion flowed into the trust fund from taxes on Social Security benefits. That's not a small number. It plays a meaningful role in keeping the system solvent. This is where the debate becomes complicated. On one hand, taxing Social Security feels unfair, especially given how outdated the thresholds are. On the other hand, eliminating these taxes entirely without replacing that revenue would accelerate the depletion of the trust fund. Instead of running out in just over 7 years, it could happen even sooner, and benefit cuts could be even deeper. So when you hear politicians talk about eliminating taxes on Social Security, understand that it's not as simple as it sounds. Without a comprehensive plan to replace that lost revenue, such a move could actually make the long-term outlook worse. As if federal taxes weren't enough, some states also tax Social Security benefits. Currently, 9 states do this: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. If you live in one of these states, you could be paying both federal and state taxes on the same Social Security income. Now let's talk about one of the most important steps you can take to protect yourself, especially if you are younger or still working, but really for everyone. After you file your taxes each year, there is one thing you absolutely must do. A few weeks after tax season, go to the Social Security Administration's website and create or log into your My Social Security account. Once you're logged in, check your earnings record carefully. This record shows how much income the SSA believes you earned each year and how much you paid into Social Security through payroll taxes. Your future benefits are calculated based on this information. Mistakes happen more often than you might think. Employers make reporting errors. Social Security numbers get entered incorrectly. Earnings sometimes fail to post properly. And if you don't catch these errors early, they can cost you dearly in retirement. I've personally seen cases where correcting an earnings record increased someone's monthly benefit by hundreds of dollars. That's not a small difference. Over the course of retirement, it can add up to tens of thousands of dollars. The problem is that the longer you wait, the harder it becomes to fix these errors. If you discover a missing year of earnings when you're already filing for retirement benefits, it may be too late. The employer may no longer exist. Records may be gone. Proof may be impossible to obtain. That's why this needs to be a habit. Every year, after tax season, check your earnings record. It takes a few minutes and could be one of the most valuable financial habits you ever develop. In the past, Social Security used to mail annual statements showing your earnings history, but that practice was discontinued to save money. Now, the responsibility falls entirely on you. The system, as it stands today, is deeply flawed. The income threshold set in 1984 should have been adjusted for inflation decades ago. Congress should have addressed the looming trust fund crisis long before now. Instead, we are left with a patchwork system that places a heavy burden on retirees who can least afford it. Until meaningful reform happens, the best thing you can do is educate yourself and plan strategically. Know how combined income works. Understand where you fall relative to the thresholds. Consider strategies like Roth conversions, which can reduce taxable income later in retirement. Be mindful of when and how you take withdrawals from retirement accounts. If you live in a state that taxes Social Security, factor that into your long-term planning. Most importantly, stay engaged. This is your money. You earned it. You paid into the system your entire working life. You deserve to understand how it works and how to protect yourself within it. Congress may continue to delay, argue, and posture, but you cannot afford to be passive. Knowledge is power, especially when it comes to something as essential as Social Security. If this information helped you, make sure you stay connected and informed. These rules matter. They affect real people, real families, and real lives. Share this with anyone you know who is receiving Social Security or will be soon. Encourage younger workers to check their earnings records now, not decades from now. Leave a comment and let me know if this surprised you, if you've been affected by these taxes, or if you're planning to take steps to protect yourself. And once you file your taxes this year, don't forget that critical step. Log in, check your earnings, and make sure every dollar you earned is counted. We're all navigating this system together. The more you understand it, the better prepared you'll be to face whatever comes next. Thanks for being here. Take care of yourself, and don't forget to like, share, and subscribe so you don't miss future updates.